Hello, John.
Hello, Joe.
How are you today?
I'm well, and yourself?
I'm doing excellent. Good afternoon, everybody. Welcome to our webinar. This is Exit Engine Exit 101. Just to make sure you're in the right place. This is selling a professional services firm. So today, this is a series of webinars that we've been doing aimed at vertical markets. But today, what we wanted to do was to talk to anybody out there who has got a professional services firm of any kind. This could be marketing agency, digital marketing, advertising, HR, recruiting,
Consulting,
legal,
general consulting.
Exactly right. Anybody who's got a professional services firm. One of the things, John, right, that we see happen a lot in professional services firms is that they can tend to stay small, right? And that one of the things that becomes it kind of becomes a lifestyle business in a way, right? You're a single consultant, but the growth of your consultancy and your ability to be able to the real value in these professional services firms, it really lies in two areas. Can you provide to a buyer, right? Can you provide market share or capability? Right.
Yeah.
And your ability inside your ability to be able to sell your consulting firm is going to rely very heavily on those two things. And we're going to talk about today as well is the ability for how involved you have to be in your professional services firm and how that has to change. Right, John?
Yeah. And also and that goes along with like scaling, right? Meaning that, how likely is it that you can grow your business, and maintain the business that you have? Like what is the buyer buying when they buy Joe Stapleton's agency or John Caniffe's consulting firm?
That's exactly right. And your ability to be able to provide them at base level, right? Additional market share, right? Whether it's clients, right? Customers, et cetera, and something that, again, that would be something they could fit into their current capability, right? Or the ability to be able to provide them with a new capability that they do not yet have, right? And again, we're talking in the case of strategic buyers, and we're going to go through all this today. But the most important thing to know right now is that today at this Exit Engine webinar, you're going to walk away with some very specific information, okay? And you're going to be able to put it to use right now as soon as this webinar is over, okay? Your growth will start right now today. We're going to teach you how to maximize your professional services firm's valuation, okay? What are the key things that the buyer is focused on? What are the things that you need to look at and improve profitability, top line revenue, all those things that we need to look at in order to maximize the value. We're going to look at common deal, John, right? The things that are the easy things that often are overlooked and are often the things that kill deals faster than you can imagine. And then we're going to talk about how you can prepare yourself for a high value exit. What are the roadmap? What's the steps that we can use to optimize financials, streamline operations, attract the right buyers? What is the process, right? Because we've got a lot of questions as we do these webinars, and a lot of time it's like people don't even know what is the process of this coming M&A work, of being acquired, or what are the things that I need to do in order to accelerate my growth in order to be able to create a higher valuation.
Yeah, and what I'm going to do too is we're gonna reference to a podcast that we did recently with Eric Goodstad, because he had some very good points about on two sides of the fence, right? He had a point of view from buying companies, but also from the sell side. So we're going to mention a couple of things, but if you get a chance, you can go to podcast@myexengine.com and look at the podcast with Eric Goodstad, because he is a practitioner in the field right now, buying and selling digital agencies.
It's an excellent point. And the reality is that they are a strategic buyer, right? They are a large agency that wants to be larger, and they are growing through acquisition. And again, we'll talk today about the professional services thing in particular, because again, it can be a very hard transition, right? It's a life decision, that you are making about where you want this thing to head. And if you're comfortable being a consultant and going in and doing the work of consultants and looking for the next project when the one project ends and things like that, and you're comfortable doing that, you can build yourself a really nice life, right?
Yes.
We are consultants. We are a professional services firm. We know exactly what you guys are going through. We have lived it. I have sold a digital marketing company that I had for 10 years. I know exactly what the pitfalls are, through this stuff. So and John has worked for.
My successful exit was a professional service firm as well. So very early in my career, I worked for a professional service firm, and then we ended up starting one and selling one. And wow, did I learn a lot during that whole process. So we'll get into some of those things.
We'll get into some of those details today. Just again, to level set, my name is Joe Stapleton. I am the founding partner and CEO of Exio Advisors and Exit Engine. I've been in this business world for 32 years or so. And in that time, I've almost been a consultant from almost the entire time. Strategy, marketing, technology, operations. I've got a lot of experience in those things. I've exited 4 companies in various ways, not all of them in a way you want to exit. To be truthful, that has only made me stronger. I've estimated that I've created about $400 million in value creation for other people. And that's kind of been my career thing. And John and I together host the Exit Engine podcast that John just referenced. You can find that at podcast.myexitengine.com and check that out. And again, we will make reference to that today, a bunch. John.
Yeah. John Caniffe, 30 years in experience. One personal exit that I mentioned was a professional service firm, but my first job out of college was at a professional service firm in 1997. And it was an investor relations consulting. And then we ended up starting a business after that and sold it in 2006. But again, we'll get into that. I also led the corporate acquisition team at a large real estate brokerage. So I was the person in charge of sourcing and vetting and ultimately buying real estate companies for a large real estate brokerage. And I'm also the co-host of the Exit Engine podcast that you should check out.
And there's some crossover there between the real estate side and the professional services side too, because again, some of the machinations that go on there are similar. But at any point, the idea here is that what we're going to talk to you about today is how can you maximize your value and saleability? Let's give you a scenario. Okay. This is what happens to us a lot. We come across people who are in various stages of their journey of business ownership, right? Sometimes we talk with people who are very early on, they're startups, and they're looking to be able to, they know they have a window, and they're looking to be able to do everything they can do in that window to make an exit, 4 or 5 years down the road, right? The reality is that most people that we talk to are, have had a business for a while. Maybe you've had it for 10 or 15 years. You might be, we've got clients who are in 30, 40 year territory. The reality is that the professional services, the growth that you've done to this point matters a great deal, but we would say that the things that you do next matter even more. And what we mean by that is that in order to be able to for your company to be a high valuation, it has to start by being sellable, right? And so in order to be able to get that, whatever the valuation is you want to get out of it, okay, 2, 3, 5, 10, 20, $30 million, whatever that is, right? We need to make sure we understand how valuation works, first of all, and what are the different ways in which we can actually value our thing. And then we're going to talk a little bit about what saleability is. So John, take us through the drivers here of the professional service firm valuations. What are the things that I need to be concerned about? How are the valuations generally done in the professional services world?
Yeah, I mean, typically it's not surprising we come back to EBITDA, and adjusted EBITDA are king. And a lot of the key metrics are, professional service firms, you can look at it also too from the standpoint of like recurring revenue, right? We've talked about SaaS in our past webinars. What is the recurring revenue that you have on an annual basis? Do you do a lot of project work? How long have your clients been with you? These are some of the things that buyers are going to ask you, and these are the questions you're going to answer. Because if you have a lot of choppy revenue, right? You're a lot of project-based work, and you're looking for that next piece of business at your clients and outside all the time, that can be tough on the valuation, because how sticky is the revenue to your firm? Whereas if you're what my company was when I first started out, was this was a subscription service that we provided information to publicly traded companies on a monthly basis. So as long as they enjoyed that information, found it valuable, and kicked it up to their bosses who found it more valuable, that was like a key thing to the stickiness of our business. So we were constantly providing value to people. If your products and services constantly provide value, you should strongly think about making your professional service firm, as much as you can, a subscription service, or add technology to it so that it can scale out. And we did both things in the scenario when we were running my company, and also benchmarks and real world comps, right? So this is obviously, you live in the real world like all of us. The company that I first started working for got an insane offer of $200 million, 4 times sales at the time in 2000 when they sold it. I wasn't part of the ownership team, but those types of things, that was driven by the nature of the business. There were a couple of big companies out there that wanted to get into the space, that were fledgling in the business, and those real world transactions and those real world bidding process drove the valuation of that particular company up to $200 million in cash. So, 4 times sales.
And that's really kind of, I was just to say, that's really kind of the key too, right? Like one of the keys to success that we'll talk about today, you bring up here, which is basically is that, you want the great situation you can get yourself into, right? And it doesn't happen automatically by any means, but is getting into a place that one of the big things that drives your value is the competition in the M&A world, right? So your ability to basically say, my company is more valuable than the next company, and to get yourself in to be attractive to as many suitors as you possibly can, which also then potentially affects, the price going up, right?
Yeah. And to the extent that you're unique, right? That you're unique. The interesting characteristics of that company that I first started work for is they were fairly unique. It was a specialized niche business. It was, on Wall Street, that was going crazy at this time in about 2000. Think of before 2000, the tech bubble that ran up, and they had technology, and they invested in the diversified products. So they started out with a core consulting product, and they added products that were sold to the same companies, and up the monthly ticket from up to $50,000 a month, up to 75, and for large companies I think it was north of 100,000 across 3 products that were delivered via a website that they created. So, and they created demand, right? They were bought by a big, very large consulting company. I'm not going to name them, but there was that bidding war that was created because that niche service, very high retention rate, and very capable, smart people at the top that were making very good decisions. And frankly, if they made mistakes, I don't remember them, frankly. So.
Right. And I think that's a really key thing. You are understanding that you are, as a professional services firm. And again, this is a size question. Okay. In this case, size to some degrees does matter. Okay. And what I mean is that, your ability to be able to, your value is absolutely pinned, okay, to the value of the similar companies in your marketplace, okay, in terms of the M&A market, right? And that could be, again, that's not geography, probably, in the world today, okay? That could be anywhere in the world. So you don't necessarily have an advantage because you're in Texas versus Atlanta, for example, right? But because I can go and source this stuff from just about anywhere. So if I'm a buyer looking for capability or market share, right, I want to go with the people that basically I'm going to go after the professional services firms to bring into my network that are going to give me the best bang for my buck, right? And so the ability for the seller, right, the professional services firm, you guys to understand that what I need to be able to do is, the first thing is make sure that I am buttoned up from an organized from a financial standpoint, right? I know how my customers come in. I know how I close business. I know who closes business. I know everybody has their role. I know about my service delivery. I'm going to have potentially, I'm going to have obviously clients. I'm going to have client testimonials. I'm going to understand how much of the market I'm actually, how much of the market I'm actually addressing and how much I'm receiving, right? There are these things that basically understanding the first step is always going to be in understanding your company, right?
Yeah. And the interesting thing about one thing just to mention that came up in the company that I work for when we sold it, and I came up in the other company is when you're a professional service firm, oftentimes the revenue is collected at the beginning of the month. And that sort of messed with some of the private equity firms is they couldn't get their head around what happens if a client fires them during a contract. Yeah, and they paid 6 months up front, right? So they got it's something to consider when you're doing your contracts is make sure that you have, it's fine to collect your revenue in front. It's ideal to collect your revenue in front. Just look at Warren Buffett, side on that. But when you have that, just realize that type of revenue collection needs to be explained to private equity. And you really have to button up like what happens to that revenue if someone does fire you during the period, because it'll definitely come up. So.
Yeah, no question about it. And so other key factors that buyers consider, again, this is the value drivers for saleability. Okay. And let's just a quick word about what's the difference between saleability and valuation. Okay. The first thing is that the valuation is the number, the dollar figure that is placed on, and by the way, in a subjective way, to be very clear, okay, on what we call the value of your company. This is the price tag. This is how much the company is worth in cash. Okay.
Yeah. And the example in mind was the 200 million. So the company, and I sort of sped through this, but the company that I worked for, I think had about $50 million in revenue and sales per year. And the offer in the company and the price that was sold for was 200 million. So if you take that 50 million in revenue, multiply it by 4, that's the multiple applied to the revenue. And you get 200 million. Now you can apply multiples to all sorts of different things like EBITDA and seller's discretionary earnings, but that's a straight one. It's a revenue, 4 times revenue. You get to a price of valuation, as Joe's just saying.
Now, and then that understand that valuation is debatable. Okay. It is completely subjective. Okay. We can get it as objective as we can, but remember that value is in the eye of the beholder. Okay. And so there's this other thing we call saleability. And this is actually to us is more important than the value, because the value comes, okay, when the saleability is there. Okay. 80% guys, okay, of people that have businesses like this their businesses will just, for one reason or another, just basically just disappear. Okay. They will close the doors. They will do nothing with it. It will just end. They will go out of business either on purpose or as a matter of dissolution. The owner will die. The owner will get divorced and leave the company behind. These are what we call the 5 Ds. These are how most people exit their businesses, right? The key to being able to sell a business, okay, is its saleability, right? And so the things that we need to consider are basically how much of your revenue, what is your revenue? What's your top line revenue? What is your revenue recurring? Are you doing, like as John said, project work? What's the sales cycle like? How does this money kind of come in over time, right? Because again, buyers are going to want to know this. Now, a strategic buyer, somebody who's already in your business, understands this, right? They are working the same way as you, right? That's an easier thing to understand and therefore an easier fit, right? But the other thing is to consider is things like growth, okay? Where has the growth in the business occurred in the past? And where is it likely to be in the future? Do you know that as the owner? Okay. Do you know what the growth is, right? What stopped you from actually taking that growth step? Is it capital, right? Which it is most of the time. Is it wherewithal? Is it like energy? I don't have it in me anymore. I'm done with this, right? Those are the things that affect growth, right? Is your ability to actually, right, use revenue and invest money to be able to grow, and your desire to be able to do the work that comes with growth, right? Do you not have, look, some people, we ask people all the time, what do you think your timeline is for exit, right? Because the first thing we got to know is, do you have time to grow this and maximize this value, or you just want out right now? And by the way, it's a question that comes up way more than you would think, right? People are come to a crossroads, especially in professional services firms, because it is let's face it, it's a slog, man. You were
Yeah.
doing work. You were often the person doing work. And even if you modeled it outright and you've got all kinds of consultants working for you and you're just the CEO or whatever it is, you're probably still very heavily involved in new business. You're probably healthy with your names in the door. You're probably very involved in closing deals and stuff like that. So the question is, how can we grow? And do you have it within you to be able to take those next steps? John, talk to us a little bit about customer concentration and why why customer concentration in a professional services firm is such a huge value driver.
Yeah, because the one reason is because if you're selling your business, and 60% of your revenue is derived from one client, right? And they're paying you a ton of money, right? They could even be paying you maybe market rates or slightly below market rates. But if you happen to lose that customer, a buyer is going to discount the revenue you get from that customer, because who knows? Like, the person who is responsible for the contract could leave. They could get promoted. They could be fired. And if 60% of what they're paying for is walking out the door, or could potentially walk out the door with the signing of exercising of one clause in a contract, you don't want that to be the case. So you want to have a diversified revenue base. You want to make sure that you're not too focused on one industry. You're not too focused on one geographic area, or like a downturn in the market. Like the company that I worked for was was working with all publicly traded companies, which in theory sounds great because they usually have more money than smaller companies. But in practice, in 2000, they lost a lot of customers just because the stock market went down and everyone had to cut budgets. And a lot of times budgets are, sometimes the first things cut out of budgets are marketing and innovation. Exactly what shouldn't be cut out. But the reality is people will look to cut things that they think can be cut. So that's why customer concentration is so important. And this isn't something that you can, shake a stick at, or you can change it in 2 minutes. You really have to consistently and by various sales plans and various strategic initiatives internally, you can do this, but it's not something that changes in 1 month, 1 quarter, or frankly, even 1 year.
No, absolutely correct. And my personal experience in selling a digital marketing company, revolved very, very much actually around customer concentration. And the fact is that we actually got lucky. So again, sometimes, we had a situation where we had 2 huge clients. We had probably have a roster of 15 clients that we did various work for, but the majority of our business came from 2 clients. Okay. And the reality was, it was probably more like 90% of our revenue between those 2 clients. It was probably definitely between 80 and 90%. That right. Is not something. And by the way, it was at every partners meeting for years. It was a topic of conversation. It was, how do we get out of this, the 2 client situation, right? If one client sneezes, we get a cold was the expression that we used, right? It was a matter of and then when we started to have suitors for sale, it was like, oh, how are we going to get around this issue? The reality was that for us, it happened to be that the 2 clients that we had were big enough Fortune 500 type clients that basically that the people that were buying us wanted into those clients with their rest of their services. And so it became, instead of it becoming a liability, it actually in and of itself became, well, those 2 clients are so valuable, and there's other services that you provide that we want to buy, capability, right, is so great that we don't even care about your customer concentration in that case. And in fact, what we think we can do is leverage your relationships there to bring in our other services into them. Let me tell you the actuality. The actuality was that never happened. Nobody was able to get into those 2 clients. Nobody did anything to be able to move that forward. What ended up happening was that they bought a digital marketing firm that happened to specialize at the time in early on social media and social media listening, right? And the ability, and then we also had a technology component, right? We could build, systems, right, very easily with an outsourced model, right? Those were the things that basically were, and we had retainer clients coming. The 2 big clients we had were retainer clients, right? And it was actually retainer plus project. So there was a lot of revenue coming from these clients, right? And a
Yep.
lot really good relationship. Here's how it affects you. Even if that happens, here's how it affects you, the owner. It affects you in the earnout. Okay. And what's an earnout? An earnout is money that you're going to be paid to continue making sure that the transition happens correctly, right, from one company into the other, and that the people who are buying you are going to rely on you to do a couple of certain things. One is to make sure that that you continue managing the company the way that you have been, right? But specifically, they're probably going to ask you to say, we're going to make contingent, right? The rest of your money, the payment that we're going to give you over the next 3 years is going to be contingent on you making sure that this client doesn't leave.
Yeah.
Right. Your relationship, you've owned this relationship for 5-10 years. You're going to continue to own that relationship and transition, and slowly over time transition the ownership of that relationship to somebody else. Right. But in a purposeful, intentional way. So the reality is that, again, even if your customer concentration is bad, you don't have to give up hope, right? But you do have to understand that it's going to be somehow or other, it's going to be your job to make sure that you don't lose those clients, because especially if those clients are valuable to the business that's buying you, right? So customer concentration, very important. Technology, John, technology and systems, right? Back office.
Well, yeah, like technology and systems, like, man, the systems we used, we had this sort of crazy way of getting information from this thing called the depository trust. And we had internal systems with bank information. And it was so important because it truly was not a cost center, and it really was a productivity tool. And over time, the system could handle so many more analysts that were doing it. So they were looking at that point to really grow out the business and really take over the industry. So the investment that this small company had made became very attractive to this large company, partially because, sure, they had all this revenue, but the growing technology that could be then scaled and built and blown out to not only their clients, but investment banking clients became huge. So if you have technology, make sure that it's productively adding to your revenue and adding to the value of your business, as opposed to being a cost center, some mix, or the worst one is, I don't know, right? Technology for technology's sake doesn't make any sense. Technology is a productivity tool and a lever that can increase the value of your business. That's gold.
And everybody is going to tell you, okay, especially nowadays, that the systems that you have, and then there's no excuse for manual systems or people doing stuff in most cases. Okay. There are AI, there's so many things right now, right, where you can cobble individual systems together with Zapier, automations, right? There's really no excuse to not have a complete sales engine and back office kind of service delivery engine, right? That can all be kind of tied together. There's just no excuse for not having one right now. And the reality is, the other thing that becomes a strategy here, especially for those of you that are kind of on the edge, okay? And what's the edge? Right now, you might be in a situation where you're making $2, $3, or $4 million a year in terms of top line billings, okay? Getting the revenue you're getting out of that, maybe you're lucky enough to be in that 20-30% kind of sweet spot in terms of your profitability, okay? So let's say that basically you're making that your profit, is going to be your profit is your top line's $3 million. So your profit is going to be, $1.2 million, about $1 million in EBITDA. Okay. Yeah. That's great. That's fantastic. Boy, you can do really well in that. You can take that money and, that money, after tax money that you pay yourself with it or whatever, and invest that in, if you've done that over a number of years, you're going to have probably a really nice nest egg, and everything's going to be fine. The problem is that what you have, or what you might be thinking, is that I've got this other big thing, this company right here, that's an asset that I'm going to sell. Okay. The problem is that, again, who are you going to sell this thing that is mostly you to? Right. So the reason that the technology stuff becomes such a factor, especially if you are have a low number of employees, if you're outsourcing a lot of work and that kind of stuff to other people, the ability to be able to build a system that you could actually roll other businesses onto,
It's huge.
okay, would be a huge opportunity for you to be able to grow your company. It's a specific strategy, and if you want to talk about it more, I'd happy to be to take anybody. If you want to send an email to info@myexitengine.com, either John or I will actually get that email. We'll talk directly to you about that idea. But the idea here is that I find things that can either, again, based on my timeline, can I do some things here that actually move the needle significantly at the end, right? As I'm ready to preparing for exit, to be able to create higher saleability and therefore a higher valuation. And the technology is one of those. And building the systems that help you scale, right, are not only going to help you. Let's just say, hey, you're done. Okay. I'm tired, man. I'm ready to retire. I made enough money. I'm good. Let's just see if we can get rid of this thing. Then one of the options for you might be that if having that technology is going to make you very, very, very attractive, right? If it's, especially if it's something that can plug in to some larger companies' existing systems and stuff like that. So you cannot put enough emphasis behind the technology and systems piece as you prepare. So let's talk, John, a little bit about some of the common things that will kill your deal, okay, and what we can do. What are some of the things that can derail, what we even think might be a great exit potential?
Yeah, and you can see all the ones on the screen. I'm not going to read all of them, but some of the ones I'm going to highlight. The top one is probably the most important, right? Misaligned valuation expectations. What does that mean, right? You have an idea of what you want for your company, or you're valuing it in some type of metric, and the buyer just does not believe that that's the case. They're discounting your revenue based on, again, high customer concentration, which is another one of these. You have the full valuation in there. You think your company's worth $10 million. They think it's worth $8 million. Well, short of another buyer, it's the value of the company is what someone will pay for it, right? Yes, you can work with them and try to convince them that you're worth 9 or 9.5 or 10 or even 10, but it really comes down to what do you believe the company's worth, and what does the buyer believe the company's worth? In conjunction with that, the poor financial documentation and messy books. If you can't run a balance sheet, an income statement, and a cash flow statement for, let's call it, the last 3 years, the last 5 years, and before the pandemic specifically, because business changed after the pandemic. If you can't pull those within minutes and have those, you should be looking at those on at least a monthly basis, right? You should be looking at all those documents to see where your money's going, what your revenue is, how your assets what your current assets are. You should have those, but those will derail exits because buyers won't wait around. There are many companies for sale, and if you can't do that, pull those general financial statements, you're in trouble. Is your cost of delivery too high? So specific to professional service firms, right? You might have a high level of revenue. You might have $30 million in revenue. You might have $25 million in revenue, $35 million in revenue. If it costs you $34 million in revenue to service that 35, well, your company's not worth very much, right? Your assets walk out the door every day, in the sense of your people are your best assets when you're a professional service firm. If you cannot make a profit on those people and on those clients, because your cost of delivery, and delivery is technology, what you're paying in salaries, your overhead, your travel, all those expenses you need to deliver your service, then your company's not going to be worth very much. And if you don't have documentation, this is really important. If you don't have your contracts, all your contracts for all your clients, it'll slow everything down, and it'll make everybody in the due diligence process go crazy, because they're going to be asking for you the same question over and over, which is why the pro tip at the bottom is so important, right? We got a question, and I'll answer it right now, is, what's the best way to reduce customer concentration? Incent your salespeople to sell new clients, right, with a higher percentage of sales. Just one example, right? You take your, you don't reward them, or you reward them less for getting new business from existing customers. You reward them more for new business, for new customers. So that's one way to do it. And that takes time. It's not easy, but it will drive things because people reply to incentives. But the pro tip is you can start early. Like start doing the customer concentration. You know what your customers are like now. You know if you're too concentrated. In the case of Joe, you have 2 major customers. Work on it. Incent your salespeople to do things like that, to give them more commission on dollars that they bring in from new customers. Get the documentation. Assign somebody a responsibility. Give a high performer, hey, collect all the contracts and make sure they're in this Google folder. Okay, if you're
basic stuff.
If your financial systems are screwed up, change your system. If you started on QuickBooks and QuickBooks doesn't work for you, there's all sorts of systems out there that are better, that are not better than QuickBooks, but are more aligned to what you have. Maybe there's a specific industry that you need to account for, and you have a system to do that. Do it now, because the more of these X's you can knock off and say, oh, our customers are no longer concentrated. Our cost of delivery, we're working on that. That's a hard one. But all those will flow up to, you probably won't be very misaligned in the future on valuation if you knock out these 4 other X's.
That's the key. That's exactly right. I mean, I think, again, we talk about valuation being, in the eye of the beholder. The ability to be able to, first of all, we always recommend a third-party evaluation anyway. So that the first thing is that you can actually get like a real valuation from a company that certifies the books at a certain place, and that helps a lot. But you're still going to have to prove why, right? So you're still going to have to go through and show the buyer all your documentation. You're going to have to show them your systems. You're going to have to show them your documentation. You're going to have to show them your customer concentration. You're going to have to show them your profitability by client, right? All of these things are because you have to remember one particular thing. In most cases, the buyer's looking to be able to make that valuation lower so that they think they get a deal, right? They want to pay the least amount of money they can so that they can make, because the idea is that they're going to do something with that that's going to make them more money. Now, in the case of strategic buyers, that may not always be the case. Not everybody is out for the best possible, like nickel and diming people. Lots of times, the best people that you find from a partnership standpoint are strategic buyers, because they're already in the industry. They understand what you do. There's a lot of stuff that you don't have to worry about, when it comes to them. But the ability to be able to start this stuff early and often, right? Exit planning is not something that you just do for a couple of weeks and then it's done. Exit planning should be something that you start doing really from day one. But the good news is you can start today wherever you are, right? And start to understand what are the things that are going to make a difference when I go to be able to sell my company, and what are the things like this that I can avoid. Let's talk a little bit about the process, John. There's different types of buyers out there. There's different deal structures, right? What do we see that's the kind of common things that are out there?
Yeah, in professional services, in my experience, in our experience, I should say, a lot of the buyers want earnouts, right? So they want to put, if you think of a deal where the total value of the deal is $100, right? Just keep it simple. The earnout, what the buyers want is to put as much money of that in the earnouts as possible, right? Because the earnouts are possibilities, right? They're not guarantees of dollars for the sellers. They're, if you build it, they will come, right? If you do this thing, protect, retain your clients that you brought to the new entity, grow new business, support this product, make sure customer retention is high, then those can be the things that are part of the earnout. And the down payment that becomes the beginning, maybe it's 50-50, right? $50 down right now and $50 in a 2-year earnout or a 3-year earnout. And the seller wants exactly the opposite. The seller wants 80% of that dollar, so $80 of that 100 in the down payment, and only $20 in the earnouts, because money down takes the town, as my grandfather used to say. So you want money, you want the cash on the barrelhead, so to speak. You want the money that is in your pocket, that's guaranteed to you. And yeah, some of it's in the earnout. So we see a lot of that professional services, because so much of professional services is, Joe Stapleton or John Caniffe or whoever the guy in the name of the door, the principals of the company. We want them around. That's why they grew this business. We want to keep them around. So earnouts are a lot of it. Cash is rare unless the business is either very unique or there's competitive offers. There's multiple offers. We'll see cash in there, but it's rare. Stock and equity, yeah, that happens with publicly traded companies, but we're seeing more of the, I don't want to put a percentage on it, but it's a lot of earnouts that are part of this, and it's strategic acquirers. It's all of these. It's aggregators and roll-ups. It's private equity firms to a lesser degree, but it's also strategic acquirers to say, hey, I want that technology, or we lost 4 customers in the last year to this small startup. I want to buy them and I want them part of our entity.
Right. And let's talk a little bit quickly about the roll-up situation and kind of explain what that is and how that works, because again, that's going to be something that you might come across as a professional services company. A roll-up essentially is basically is like a conglomerate in a way. The idea is that we're taking a bunch of similar companies, and and a single buyer would go out and basically get 4 or 5 of these companies, find whatever the commonality is between those. I mean, often it's a back office system or something like that they can actually really make efficient, or do something special that helps service delivery or helps sales or does something, and then be able to basically roll those things. It's called that's like a platform. And then what we're doing is basically rolling these other companies onto it and integrating them as you go, and then you're rolling these companies up into one other company. And then what that buyer is going to do is turn around and sell all of those companies in one single entity to another larger buyer. Okay. And the reason the roll-up strategy becomes important to talk about here in this particular audience is the roll-up strategy is a way for you to grow quickly. Okay. It's also a way for you to be able to get what we call a second bite at the apple. All right. So it might be that you sell the majority of the majority of your equity in a company that you own. Okay. And what you're going to do is, in return for that, you're going to get cash, right? And then your earnout is going to include some kind of stock or equity in the company that's acquiring you. Okay. You'll stay and you'll work and get paid a salary and do all the things that you used to do at the company as if it's still your company, basically, right? The difference is that you're now going to be owned. You'll be working for somebody else. You'll be working for an ownership, the whole thing, but you've gotten paid big time. You're continuing to get a salary, and you're getting again, equity stake in this new company. Now, when this new company is sold one day, you're getting your equity play out of that as well.
Yeah. And the most important part of that scenario is that you get equity in the entity that's that you're rolled into, and that you are confident that the company that is rolling you up, that you're becoming a part of, is going to sell one day, and it's going to keep growing, right? The point of the rolled equity strategy is you're giving up a big piece of your pie and selling it for a smaller piece of a bigger pie that you'll again generate more money in the future when that company's sold. But the key thing is, do you have confidence that the company that's buying you knows what they're doing? Because you're becoming business partners with them. You're becoming equity partners with them. You need to make sure that they know what they're doing and that you believe in the strategy. But it can work for dental practices and medical practices, and to a degree franchisees in certain situations. So yeah.
And so it's worth, that's why it was just worth kind of pointing out. Look, the other thing, guys, is that understand this, okay? And this is just 60%, okay, of founders will say after the deal is done that they were very or somewhat disappointed in the entire exit. Okay. And we're not saying this to scare you or to stop you, but understand that lots of what this means is that the other thing that happens here is that people don't know that they can ask for other things too. This isn't just about money. This is also about your life's work, what you've done, the people that you've mentored and hired and brought along the way, the people who have come to become your support staff, the people who have made this thing grow. What happens to them? What do you want to see happen? Right? You want them all to be brought on? Do you want to give them, are some of them going to get bonuses? Or you have to worry about them staying. There's all kinds of things that you have to worry about there. But also it's stuff like sometimes these deals, especially with strategic acquirers, can be very creative.
Yeah.
What's important, the point is that what is important to you, right? Besides just the money and the timing and that kind of stuff, right? Is it, I want my wife to be paid in perpetuity for the rest of our lives, right? Is that something that you could maneuver? Something you could ask for it, right? But the idea is that to understand that as you go through this thing is that the happiness comes not from you sell it, but from the day you finally are done and integrated it with the next company.
Yep.
Because chances are you're going to be there for those 2 or 3 years that it takes to do that in addition. And to be happy with the deal, you're going to need to understand that you can ask for things and you're getting things on your own terms. That's what a good deal is, right? Let's talk about the timeline overall, okay? You've got this pre-market preparation phase. How long does this stuff take? A general exit, if you were buttoned up and all ready to go, you might be able to do it in 9 months, maybe. But the reality is that what we find is that most people are not nearly as ready as they think they are. And most people start this process one of two ways. One is they're just exhausted, right? And so many of you out there might feel that way. I've been carrying this thing for a long time, been a lot of pressure. I've done well, but I'm ready to get out. The other thing that makes this happen to the timeline is often a sudden drop in revenue. Something has happened, and now I'm looking at this thing and I'm starting to see that this is starting to erode away. What's the problem? Okay. And can I get this ready? Well, that's going to take probably, that timeline might be different. You might want to be out in 9 months, but that's probably going to take a lot more time because there's going to be some things you're going to need to do in order to maximize the value, especially if you're seeing a trend of revenue or EBITDA or anything else going down, right?
Yeah, and we talked about all these things, I think, in previous things, but just financial operational cleanup, scalability and growth, exit planning and valuation planning. Again, we discussed these, but these are things you want to start very early on in the process so that you can. Because again, these aren't things that can be done in 2 weeks. These aren't things that can be done in 2 months. It's something that needs to be started early because it requires a lot of action by many different people at the entity, at your company.
That's right. And keep in mind that one way to be able to get to know where you stand is that right now you can go and take our small assessment. It takes 2.5 minutes. You can go to assessment.myexitengine.com. You can go right now and it will give you a total exit value score. Okay. Yeah. It'll show you exactly what are the things that you'll need to examine more closely in order to maximize your value and saleability. So feel free at any point to go. Yeah, it's available all the time. But it's a great place to start. The next step is your go to market and your buyer outreach. This is you as a product on the open market. Okay. It's about the marketing materials, what we call a SIM, a confidential information memorandum is what they call it in the business. You're looking at basically your deck. This is who we are. This is the story. This is where we came from. These are the owners. This is the why this company. This is why this company, why these owners, and why right now is the things you're trying to basically to make the case for. You're gonna target buyers and list outreach. You're gonna go to other companies. You're gonna go to your strategic buyers first. You're gonna start looking at around. Maybe competitors in your marketplace. It's not a bad idea if you really are serious and you're at a place right now to be able to go to those people and say, hey, look, what do you think about us getting together? Right? We might be actually better together than we are apart. And could we work at a deal where that could happen? Right? You want to screen and qualify buyers. You got to make sure that not everybody is for real. And I got to tell you that one of the things that you have to be the most careful about in this process is people will take you out a long way before you find out that they are full of crap.
Yeah. And there's opportunity cost there, right? The opportunity cost, we were dealing with one particular buyer for one of our clients that was completely not real. It wasn't crazy or anything, but just not real. I don't know if he didn't have the money or whatever, but it just wasted a lot of time. We could have been doing other things. So Joe's exactly right. is when you're vetting these buyers, or we're helping you vet these buyers, they will be qualified. They will be real with real money. You want to avoid search firms. You want to avoid firms that like are searching for companies and then they'll find the money after they find the company. Those just take forever. And there's other buyers out there that it should be prioritized.
That's exactly right. You what you want is any kind of buyer who has the money, who has the wherewithal right now to be able to make this deal, and has, by the way, also you can't stress enough, has a clue about what they're doing, right? Because the other thing that goes into this is that you need two parties here, and again, we're going to talk about building in your exit task force. This is what you need to be able to get this done is probably a significant amount of outside help, and it's just the truth. This is not a self promotion. This doesn't have to be us, but what you do need for sure is that you are going to need to build both an internal and external team that works together to help you through all of this. And the reason is that there's going to be contracts, so you're going to need an attorney. And you're going to want to hire, frankly, an M&A attorney who has the experience in doing this M&A work. You're going to need some kind of outside accountant, not just the one you have, but probably a third party at least to be able to even look at the books and be able to make a certification from a third party standpoint. You're going to need other accounts. You might need specialists to come in from a growth standpoint, right? But either way, you got to make sure that the people that you are bringing in who are saying they want to buy your company are real and legit, and you need to have the resources to be able to check that stuff, and ask the hard questions. You got to, what happens too is people are like so excited that they have a buyer here that they don't want to ask the hard questions until they move through the process. The reality is you're saving yourself time and energy and effort if you get to that stuff at the beginning and qualify the buyer right away. Very, very important. Obviously, then you're going to get to initial meetings with the buyer's real. You're going to start kind of executing the NDA. You're going to start to basically go into what we call due diligence, right? You're going to get, first of all, you should get a letter of intent, or at least some kind of letter that says, this is the offer, this is what we do. And the reason you want this from the buyer is because this puts everything else you're doing on hold temporarily. Okay. In other words, there are things that this is going to say you can't, you're not going to go to another buyer, right? You're not going to do things behind my back while we're negotiating in good faith.
You're not going to shop the offer to other buyers.
Exactly. And so and again, this is the point at which you want to look at these things very, very carefully, especially if this is the first time you've been through this before. Okay. These LOIs can be very complicated, and they can be situations where you have to really make sure that what you're reading, what you're getting into, because sometimes
that's another reason why you want to bring in professionals, people who have done this before. There's all sorts of things in due diligence and in the contracts that look innocuous or can look innocuous, and they're not, right? They lock you up with, just one example is too long a time to be exclusively negotiating. Yes, there's a period of time where you should be exclusive, but it shouldn't be excessive. And by excessive, it shouldn't be more than 60 days in most cases. Certainly shouldn't be 90 days. So there's key things in here that, yes, there's some things that are obvious, but there's some other things that are subtle and not obvious that experts can help you avoid a lot of pain and a lot of just unnecessary work that you don't need to do. So
no question about it. We get into due diligence, and at this point, hopefully you have hired someone who has already put you through these paces and already discovered the things that are wrong or need to be adjusted and whatever.
Yeah, right? And a lot of the stuff that we've talked about those 4 X's that I went over on the prior screen that we covered, are methods to make due diligence move a lot more smoothly. What will come up in due diligence is revenue concentration. What will come up in due diligence is your contracts. What will come up in due diligence is your financials, because they're going to dig into them. They're going to dig all the way down into them the last couple of years. So a lot of what we do up front and the work we do in the phase 1 and phase 2 is the goal is to make phase 4 very easy, very clear, and transparent.
Exactly right. And keep in mind that, this is a difficult thing to get through, and that you will lose more deals. You only need one deal to go through. Okay. But it's very possible that you will go through 2, 3, 4 or more kind of situations like this before a deal actually closes. About half the deals that are put on the table, and that's across all M&A stuff in the mid-market, basically actually go through. So the idea is that, again, preparing yourself and going through this stuff and being buttoned up is a key to success. There's no question about it. The last phase, the closing, the post-deal transition, right? You're talking about, you're finalizing all the legal and financial closing requirements, everything you've agreed to, right? You are executing the agreements, you're transferring the ownership, you're closing the any of the assets or any of the money and all that stuff is basically going place to place. And then you're going to be in this longer period of this integration and earnout, right? That we talked about before.
The most important part of that point is the earnout period, right? Is earnout metrics. Be clear about when you're signing these deals that you understand the metrics, you can control them, and you know when you're being paid on those earnout metrics. That's vitally important.
And I would say that make sure that the integration points, here's another place where things go horribly awry. People talk a lot about synergy, and they talk a lot about integration, and they talk a lot about all the things that we see that we're going to be able to work together on, et cetera, et cetera. Two things that as the seller, you must make sure are in these contracts. The first is that what is the actual integration plan? What do we do? How does it work? Who stays? Who goes? What are the timelines for things? What are the expectations? And that's all put out ahead of time. What you don't want to do is be in a situation where you're in an earnout and the company that's bought you is making you do stuff that you're not used to doing or whatever, and changing your process or doing things that you now can't control. Okay. That's going to help. That's going to kill your earnout. The other thing is that the earnout itself, what are the specific factors that are going to make or break your earnout? Right. And make sure that the things that are in there are things that you can have direct control over. Right. We want to make sure that you are, to the degree that you can. Obviously, things may go wrong and things might happen, but the idea, especially with any other earnout things, to make sure that you've got all this stuff written down, and that before you sign anything, and make sure that stuff is all in place. So let's talk very briefly about what what we can give you today, okay, are going to be things that you can do right now, okay? So this is these 12 things are things that you can do right now to increase your total exit value. You can start them right away. We won't read all of them, but the idea, we'll just go through a couple of key ones. And the first, John, the very first most important thing is that you develop what we call an exit mindset. Why is an exit mindset so important to, especially to professional services people?
Well, it goes back to my favorite phrase, and I'll say it once: is what got you here won't get you there, right? So what got you to this point in your business is not exit planning, right? Meaning you got here by running your business. You didn't get here by thinking of how to sell your business. So what you need to do now in order to sell your business, you need to pivot, and you need to think of your business as a product, and that's developing the exit mindset. Is your product that you as a CEO are now selling is your business, and that's a key thing. So everything else in this list flows from that. So develop the exit mindset to realize that you need to sell your business. There's things you need to do that. And the second thing is, after the exit mindset, is your exit goals. Define what you want. Because if you don't know what you want, how will you know when you get it? Right? And someone offers you something that's way out of left field or something that's different, you won't know how to react. If you have your goals written down and you achieve 3 of these 4 goals with this first offer, might be something to think about taking it. Some of these other ones we've talked about previously is obviously optimize your financials. We didn't really talk about risk and strengthening your business operations, but obviously those are important. If you're too reliant on one supplier, you want to avoid doing that. Number 7 is super important. It's strong leadership team. And we didn't really talk about this at all, but with the professional services companies, you really need to have your key employees locked up and your leadership team well-defined and in place. Because if you go or you leave the company at some point, and you're probably going to leave after you get bought, after your earnout period, the buyer wants to ensure that they know people that can run the company that are already there. Exactly. Again, we've talked about a couple of them with recurring revenue, customer concentration, and the thing that Joe mentioned that's really important is expertise. And I think of 10 when I think of expertise is you don't want to get crushed with taxes. There's all sorts of stories about people that sell a company and either through bad tax planning or bad venture capital raising, or some screw up very early in the process where they sell their business for $200 million. They only own 1% of it, and they end up owing the government a ton of money because of just bad or no tax advice and bad financial raising. So again, all of these are important. Review them, but the ones that we highlighted are of critical importance.
Absolutely. So again, these are things that you could start today, guys, right now. So where do we go from here? Obviously, take that list, take it to heart, understand all those areas of your business that you need to basically to examine, and start examining them. Ask questions, start uncovering them, take a look at, ask the people who are running those departments what they think. You want to be able to, the first step in all this, again, like we said, is the mindset. It's starting to think about in the way in which I need to be able to rearrange things, to make them, to optimize them, to be the friendliest, to the buyer community that I possibly can. And the great way to start, guys, as we said before, is to understanding this is to take our free assessment. It's free. It takes about 2.5 minutes. We're not going to ask you for any personal information or anything like that. This is just for you. But if you do this assessment, http://assessment.myexitengine.com, take that assessment, get the results. You'll get a free report from that. And you can have a phone call with us to go over them so you can understand that however you'd like to do it. But the reality is that this is going to be your first step. And if you need some more information, you can always go. We've got, as we mentioned at the top of the show, we've got a podcast. It's called the Exit Engine Podcast. It's released every Friday. I think, John, we're getting close to episode 40. There's a lot of information there. So you can go to podcast.myexitengine.com. A lot of good stuff. And of course, you can follow us. We're all over LinkedIn. At Exit Engine or Exit Engine Community on LinkedIn. You can find that there. And we would love to be able to chat. You can always just send us a direct, if you've got some questions, you can always just send us directly questions at info@myexitengine.com. We're always open and love to get some questions. We only have a couple of minutes. I know that we're a little bit over time, but there are two questions. John?
There's one question I want to answer about, can you share examples of how founders are disappointed post-exit and what could have changed their outcome? Google FanDuel. If you're familiar with FanDuel, it's the classic case of companies that they raised a ton of money. They built an incredible business. The FanDuel casinos are all over the web. You hear them and now the NBA playoffs. I think they raised $400 million and they sold it for something north of that, but not very much. But the point of it is, if you're a founder and you've raised all this money and you've done this, this is an example of one where they made very little money from that. They made nowhere near $400 million. They made nowhere near $5 million. So you have to get expertise when you're raising money or selling your company or planning for taxes or getting a big payout. It's just logical sense. When you buy a house, usually use an attorney, use a real estate agent. Make sure that experts are there when you need them. And if it's a critical business decision involving a lot of money, get an expert involved.
No question about it. One other question that I think we've got here that would be worth going over. Someone asked, what are the key differences in expectations between strategic buyers and private equity firms? Which is a really good question. So we are not anti-private equity firm. Okay, not at all. Private equity firms have a place for sure. They come at things from a different perspective than normally than strategic buyers do. Strategic buyer, basically, like we said before, they are looking for one of two things. They're looking for market share or they're looking for capability. Okay. And they think that they can buy that capability faster than they can build it. Okay. And so, like in my personal case, we were very early on in terms of helping people with their social media stuff. That was a capability that the company that was buying us really wanted to have. And they realized that it was going to take them a lot longer to build that from scratch than it would be to buy it. And by the way, they were also getting all these other things they didn't have in addition as well. So that was a good value, right? So a strategic buyer is looking to buy the things that you're doing and integrate them into what they're already doing. A private equity firm, on the other hand, is going to come at this, from scratch. Now, they might be in the roll-up game. They might be an aggregator. Okay. But most of the time, what they're going to do is they are looking to basically, they have built a fund of money. That fund is made up of individual investors, institutional investors. Some of that money is your 401k. Okay. And they have a big pot of money, and they have to take this money and they have to invest it in companies. If they don't invest it in a period of time, they have to give it back. Okay. So what they're trying to do is put this money and make an investment into lots of companies in a year in certain areas in which they have operating experience. In other words, they have people they can tap to run the company. They can bring in a CEO. They can do things. They can have a salesperson. They have expertise that they can bring to bear. And what their goal is most of the time is in 3 to 5 years, what they're looking to do is to build that company, make a 30% profit, and resell it. Okay. If along the way, they will also charge that company management fees for doing the work of getting the company together and all that stuff. Okay. And so one way or the other, that private equity firm is going to make money on that company, even if it ends up that they end up selling it for parts later on. Okay. And so the problem with the private equity company is that, the basic gist is that they don't really care about you, the owner. They're just looking at your asset and trying to get your asset, whatever. Whereas a strategic buyer often is going to be a better business partner for you. Makes sense most of the time. And so those are really the two, big differences. We are way over our time today, but we wanted to say thank you so much for coming. Again, guys, as a professional services firm, it is never too early to start thinking about your exit and doing the things you need to do to be able to maximize your value and saleability. That might be making an acquisition of your own beforehand, right? So leave yourself some time, right? I know you're probably, many of you are very tired. You want out. We totally get that. But, and if you'd like to have a conversation about how we can help you do that, and again, come to us at info@myexitengine.com. Check out the podcast, do the assessment at myexitengine.com, see for yourself where you're at, start to get a sense of what you can do, and then have a conversation with us, because what you may learn is that you have many options, right? But getting someone in your corner to help you figure out what those things are is of utmost importance, right? Thanks a lot, John. This is another great session today. Appreciate your help.
Thanks, Joe.
And guys, have a great one. Again, this is the Exit Engine. Come find us at myexitengine.com, or send us an email, info@myexitengine. Have a great day.